All right, let's talk about Monolithic Power Systems, or MPWR, because their last earnings report was a real head scratcher. Here's a company that, by all accounts, did everything right. They beat on earnings, they raised their guidance, and the stock just got hammered. It's a classic Wall Street paradox, and we're going to unpack exactly what went down. So this slide right here, this lays out the puzzle perfectly. On the left, you've got the result, a clean beat and raise. I mean, that's the textbook definition of a great quarter. But then you look at the reaction, a drop of nearly 8% the very next day. So what gives? How does that even happen? Well, to figure it out, we first have to look at just how good the results actually were. So let's break down this Q3 beat, because on paper, the numbers were just undeniably strong. You really can't argue with them. This was a company that looked like it was absolutely firing on all cylinders. First up, the top line, revenue. They pulled in over $737 million. Now that was a solid 15 million bucks more than the analysts on the street were even hoping for. And it's up almost 19% from last year. That's a really, really strong number. And the profitability was right there with it. On the bottom line, their earnings per share came in at $4.73. That cleared the Wall Street forecast by about a dime. So you've got a beat on revenue and a beat on profit. Check and check. And this is super important. Their gross margins held up beautifully, right at 55.5%. For a chip company, this tells you they have real pricing power. You know, they're not just slashing prices and giving their stuff away to hit that big revenue number. They're growing and staying highly profitable. So where did all that growth come from? Well, that's the interesting part. It was pretty broad, but the real powerhouses were enterprise data and storage and computing. And no surprise here, those are the segments getting a massive tailwind from the whole AI boom. Automotive also had a fantastic quarter. So the story here is just solid execution everywhere it counts. Okay, so the quarter itself was great. You can't poke any holes in it. So maybe the problem was the guidance. What did they say about the future? Let's get into the forward look, because this is where the plot really starts to thicken. So first, the CEO gets on the call and he lays out this big, grand vision for the company. He's saying, look, we're not just selling you individual little chips anymore. They're moving up the food chain. They're becoming a solutions provider, selling whole integrated systems. It's a huge strategic shift that should, in theory, mean they're way more valuable to their customers. And get this, their actual guidance for the next quarter seemed to totally back that up. They guided for revenue of $740 million. That was higher than what Wall Street was predicting. So just to recap, they beat the quarter and they raised the forecast for the next one. That 8% drop is looking crazier by the second, right? But then you get to the Q&A session. This is where the analysts start poking and prodding, and you start to hear a slightly different, more cautious tone from management. They talked up AI, sure, but they seemed kind of wary of all the hype. They mentioned that they don't have a lot of visibility because customers are only placing short-term orders. And that cool new robotics win, they flat out said it's not going to move the needle on revenue until 2026. This is our first big clue. Okay, let's put all the pieces together. It's time to answer the big question. With a clear beat and a solid raise, why on earth did the market just dump this stock? This is a textbook case of a good quarter simply not being good enough. So what explains this huge disconnect between what the company did and how the market reacted? Well, the answer has almost nothing to do with the quarter itself and everything to do with context and, more importantly, expectations. And make no mistake, the market's reaction was swift and decisive. This wasn't a slow drift down. The trading volume, the number of shares that changed hands, was nearly triple the daily average. That tells you the big institutional players, the ones who move markets, were selling with conviction. And this right here, this is the smoking gun. This is the whole story. You have to look at what the stock did before the earnings report came out. In just 3 months, it ran up a jaw-dropping 28%. It went from below $800 a share to almost $1,100. So the market wasn't just expecting a good quarter. It had priced in an earth-shattering, AI-fueled blowout of epic proportions. And that's really the bottom line. The market was positioned for utter perfection, and what Monolithic Power delivered was very good. Now, on any normal day, very good is fantastic, and the stock would have gone up. But when expectations are in the stratosphere, very good feels like a letdown. It is the classic Wall Street story: buy the rumor, sell the news. So that explains the past, but what we really care about is the future. Now that all that crazy expectation has been washed out of the stock, how should we be thinking about it from here? It's time for the next call. Okay, so here's our official take. We're rating the stock market perform. Now, what that means is we expect it to perform pretty much in line with all the other major semiconductor stocks. Look, this is a fantastic company in all the right growth areas like AI and auto, and honestly, this pullback was healthy. It was needed. But for the stock to really start outperforming again, we're going to need more clarity from management on those big AI projects they hinted at for 2026.
Now, if you're thinking about this from a trading perspective, here's one plausible way to look at it. The main thesis is simple. The big sell-off just created a much cleaner, more attractive entry point for a really high-quality company. The catalyst you'd be watching for is any new commentary in the coming quarters that gives more detail on those 2026 ramps for AI and automotive. And as for structure, one way you could play it is by looking at long-dated call options, say out to June 2026. That lets you capture the long-term upside while keeping your risk clearly defined from the start.
So the big takeaway here is that context is everything in the market. A company can post a great quarter and still see its stock sell off if expectations just get too far ahead of reality. But sometimes a sharp, painful reset like this one is exactly what creates the next great opportunity. And as always, a reminder that this is not financial advice.